Hello everyone, welcome to Officer 24/7. My name is Nehar Kavalia Bhatnagar and I'm with you with the area of accounting and financial management for bankers. And we are talking about May 2024 and this is our series for achievers. Acha everyone, what have we started with? We had started with a specific chapter called the depreciation. So I'm going to continue with depreciation with new numerical questions. So this is what we'll be considering in the particular class. First of all, if you like the session, go ahead and click it up. Like the session. If you had been watching my series, please like my sessions every single time you see the video coming up, because your appreciation is the first and the foremost thing that keeps us going on. Secondly, if this particular session is helping you, please go ahead and share it among your peers as well. Thirdly, if you haven't subscribed to our channel yet, then go ahead and subscribe the channel. So let's continue further and let's talk about depreciation in detail. I'm going to talk about depreciation from the point of view of numerical as well as from the theoretical point of view. Plus, when we talk about this particular chapter, there is depreciation. It's a super duper important chapter. This particular chapter is extremely important just because of the fact that this particular chapter has been asked in the examination not only from the point of view of case studies, but this was in the previous syllabus. It was in the module A, one of the most important modules which had greater weightage as compared to other modules. So now let's continue. Okay, so we were talking about depreciation and its accounting. Acha, what do you mean by depreciation, everyone? Depreciation is usage, wear and tear. For example, let's talk about it. I have my specific, I'm just using a specific phone. So if I'm using my phone, then this particular phone is used every single day. So if it's used every single day, its value is decreasing every single day, right? If I bought a phone today, now after 3 months, its value is going to decline. After 10 months, it's going to decline further. And after the particular time when the entire, I would say, when the entire models are changed, then the price goes down like further, right? So when a new model comes, the old model loses its price. The same thing happens with the cars and same thing happens with the machineries that are being used in the organizations. So it's way too challenging to utilize something like that. Now, when we talk about depreciation, how does it work? Acha, we have done this part yesterday, so the same slide is still available, just in case you haven't seen the previous class. And if you haven't, then go ahead and watch the entire series. I've covered from module A, unit 1 till now. So this is what you'll find in the previous class as well. What is depreciation? Depreciation is a non-cash expense. Why do I say non-cash expense? This expense is not paid to anybody else, but only you know कि अरे I am incurring expenses because I'm looking forward to my survival. Every business looks forward to it. The decrease in the value of an asset is due to its use caused by wear and tear or by any other reasons. So that's how we define the area of the depreciation. And always remember, depreciation is compulsory, right? You cannot skip the portion of depreciation. It is not voluntary. Once you start using an asset, it is depreciable. And there is no point where the depreciation is not applied. Secondly, we talked about the depreciation over the period of time. Acha, everybody, we talked about depreciation. Na? Do you know, before I proceed further, how many methods are there? In terms of depreciation, the methods which are covered in your book only. That is all the portion that I'll be discussing. The number one method that is given is original cost or SLM, straight line method, uh, or SLM method. Second method is called diminishing value method or WDV method. वैसे there are other names as well, but these are the most common ones: diminishing value method and WDV, written down value method. Then the third one is double declining. Then the fourth one that is covered in the book is sum of digits. And the last one is units of production. That is based upon the units that you produce. So if you produce more units, more depreciation. You produce less units, so less depreciation. That's the entire crux of the units of production area. Sum of digits, there's a specific formula for it. Double declining is basically doubling your depreciation because of its usage. If it's used more, then the double declining method would be there. Acha. Moving forward towards the questions. So we are going to cover the area of SLM as well as the WDV. Acha, in the examination now they have started playing with us. They are asking the questions not only from the formulas but also from the point of view of the fact that they are asking the questions on what basis those formulas are made. Matlab, they are asking questions from the area of assumptions even. Smart work. That means people cannot just say, "Ki nahi, nahi, ma'am, I know numerical more, I'll just do the numerical part." Or you can say, "Ki nahi, nahi, I'll do the theory more because I'm good at theory." They are asking questions which are theoretical but taken from the numerical area. So that's the smart work that they are doing in terms of the IIBF examination. So how much prepared we are is something that we have to determine. Acha, so I've given you the entire brief information of all the particular operations. Now tell me everyone, what is the basis of calculating the annual depreciation in the SLM method? SLM method is also called original cost method. It is also called fixed installment method. So that's the third name, right? So what is it based upon? Salvage value, purchase price, estimated useful life, or all of the above? What is the basis for calculating annual depreciation? When we talk about the basis for calculating the annual depreciation, uh, the scrap value is super important. Purchase price is again super important. Then estimated useful life is again a very vital part of it. So all these things are extremely important. So what makes the answer is all of the above are super duper important when it comes to the area of depreciation. Acha, how is the annual depreciation calculated in the straight line method? What's the formula? Purchase price minus salvage value, purchase price divided by estimated useful life, salvage value divided by estimated useful life, and then is purchase price plus the salvage value. What would be your answer, everyone? I think I might have to improvise the particular point. It is actually whatever your purchase price is under straight line method, whatever your वैसे तो B would be the answer, but normally there is one more point there. Whatever your purchase price is minus your, if there is a salvage value, then you consider it. If it is nil, then obviously this turns out to be 0 divided by the estimated life. For example, everyone, I bought a machinery worth rupees 20,000. By the end of fourth year, I can sell it for 4,000. And its life is for total 4 years. So in this case, it would be 16,000 is the total amount that you will recover from the machinery in over the period of time, 4 years. So technically, in this case, my answer is going to be rupees 4,000. Got it, everyone? So in this case, the answer is going to be the purchase price minus the salvage value, scrap value, or residual value. Any of these things divided by the estimated useful life of the asset. So this is what we consider when we are making this particular area. Now comes the next point. Why is the straight line method more relevant in for assets like plant and machinery? It considers the market fluctuations. It provides tax advantages. It assumes the constant, consistent performance over the useful life, or it allows for accelerated depreciation. What would be the answer? Why is the straight line? See, वैसे ना, if you look at the income tax department, it allows only the usage of SLM or the WDV method. Rest other methods are not used. This is an easier method. One of the easiest methods is SLM or straight line method. Okay, so why is this more utilized in this case? Basically it says कि if we talk about our business there, we will assume that throughout the life we are going at the same pace na. So in this case it is assumed that the constant or consistent performance is there over the useful life. Okay, now comes the very important question, that is what is the primary difference between diminishing balance method and the straight line method? Okay, so in this case, what would be the answer, everyone? When you're looking at the primary difference, but one of the major differences between WDV and SLM is SLM says throughout the life have the same depreciation. Diminishing balance method says you have more depreciation in the beginning because by the end of the life of the asset, it's almost gone. If I look at the depreciation of my phone, I just open the seal 10,000 minus. If it's an iPhone, you bought it for 80,000, then obviously nobody is going to buy at 80. If you have just sealed open and then you didn't use it, maybe 75K. After a month, it will decline further. Maybe after 6 to 8 months, it would decline at 70. After 2, 3 years, we all know that we will get not more than 40, 45, or even less than that for that, right? Because once 2, 3 years have passed, the new the version of that particular model is available at the same price as at we are trying to quote. So technically, in the beginning, the depreciation is more, and by the end, it reduces further. This is the particular thing which diminishing balance method says. In the original cost method, whatever our original cost is, you find the depreciation and then the same depreciation is there till the end of the life of the asset. While in terms of WDV or written down value method, once the value of the machinery is chosen, the depreciation is charged in such a way that if the total amount is 10,000, say your depreciation is 5% in the first year. So it would be 500 rupees in the first year. You are left with 9,500. Then in the next year, again 500 of the 5% of 9,500. Whatever your closing balances under the portion of WDV method, you choose the closing value and the depreciation is charged on the closing value. It is not on any other thing, but it is on the closing value. The diminishing balance method assumes a constant depreciation value. The diminishing balance method assumes a constant depreciation rate. Straight line assumes more depreciation in the early days, and the straight line method assumes more depreciation in the early days. वैसे तो स्ट्रेट लाइन मेथड assumes same value. ठीक है, they have the same value. While when we talk about WDV, it says the depreciation rate is same. The difference doesn't occur anywhere else. It is just the constant depreciation rate. Now, how is the annual depreciation calculated in the diminishing balance method? Purchase price divided by estimated useful life, purchase previous year's value into percentage, or purchase price minus salvage value, or salvage value divided by estimated useful life. How is the annual depreciation calculated? When we talk about the annual depreciation calculated, annual depreciation is calculated on the basis of in WDV. Whatever your closing value of the previous year is, you will always find the closing value and multiplied by the percentage of depreciation. And that particular, the rate remains the same, the value keeps on changing after every year. So depreciation overall will vary. So in this case, the correct answer will come out to be the previous year's value multiplied by the percentage rate. Now comes, what does more depreciation tends to occur earlier in asset life mean in context of the diminishing balance method? The asset increases in value over the time, the asset loses more value in the later years, asset loses more value in early years, or depreciation is constant throughout the life of that particular asset, everyone. What would be the answer in this case? We have just talked about it, and the example was an iPhone. The value decreases more in the initial years because you buy it and then you are using it, and then the value goes down. So once the value goes down, it's definitely gonna something that is going to hurt us. So right. So when we talk about this area, it's gonna be like that only. Now comes the asset loses more value in the initial years, and after that, once it's declined, it is declining only. Then you are mentally prepared case ki value, the value of the same is just going, the value of that particular asset is not going to have a sudden major dip. It is just in the beginning that you will find a major dip. In which situations is the diminishing balance method more relevant? When the asset is expected to provide consistent performance over its life, Then when the asset is expected to give better performance in the initial periods, when the asset's market value is unpredictable, or when the tax benefits are a primary consideration. When we talk about diminishing balance method, when you are using it more in the initial years, and then it would be stabilized. So then, because in the depreciation in the initial years on the basis of rate would be more. If the value is high, then obviously if I bought an asset for 10 lakh rupees, now let's look at this. I bought an asset for 10 lakh rupees. The depreciation on it was 10%. So in the first year, the depreciation was way too high. It was 1 lakh rupees. Now I'm left with 9 lakh rupees. On the basis of this 9 lakh, again 10%, that is of 90,000 rupees. So I'm left with 8 lakh 10,000 rupees. Then if you look at the remaining 10%, then it is basically 81,000. Then you are left with 729,000. Can you see the point there? The depreciation is decreasing because your opening value or the closing value of the previous year is decreasing. So if the value is decreasing, the rate is always on the closing value of the previous year. So technically it keeps on going down, it is dipping. So you will always find more depreciation in the initial years and lesser depreciation in the later years. That is because the value of the asset is more in the beginning, and the rate is always calculated on the closing value of the previous year. Now, in terms of original cost, if it is 10 lakh rupees, this is WDV everyone. And if I show you the SLM method, if this is of rupees 10 lakh, na, so every time you will find the depreciation remains the same. In the first year, it is same. In the second year, continued with the same amount, because it is said to be 10% of your original cost, the cost at which you bought it. So we are left with 8 lakhs. Then you remove further. Then you are left with 7 lakhs. So you can see the difference. That is, the diminishing value method is more realistic. It says that when we are using thing, then the value falls down more, right? Now here comes a question that everyone. A company purchases equipment for rupees 50,000 with a salvage value of rupees 5,000 and estimated useful life of 5 years. What is the annual depreciation using the straight line method? 10,000, 9,000, 8,000, 7,000. Okay, so let's calculate this question, everyone. Showing you the method. Under SLM method, what is the formula? It is your cost price or invoice price minus your residual value divided by estimated useful life. So technically we have 50,000 minus 5,000 divided by 5 years. So in this case the amount is of rupees 45,000. You know, 45,000 divided by 5 years. So if the life of that asset is 5 years, na? So in this case, the answer comes out to be 9,000 rupees is the depreciation per annum. So over the next 5 years, we will depreciate rupees 9,000 every single year. So your depreciation is going to be this. Acha. Just a little moment is required. I'll just, this was the formula. Okay, it is actually annual depreciation is equal to, this is the amount, so in this case the amount turns out to be rupees 9,000 altogether. So this is how you can see it, everyone. We have the purchase price minus salvage value. Salvage value is also called residual value. Okay, done everyone? One more question to go. An office building was purchased for 2 lakh with a salvage value of 20,000. Estimated life is 20 years. Calculate the book value at the end of 10th year. 2 lakh minus 20,000 divided by 20 years. So technically annual depreciation is whatever your purchase price. You bought it for 2 lakh and you remove the salvage value of 20,000. You know, and the life is 20 years. So technically that comes out to be 1 lakh 80,000 and you divide it by 20. So in this case, my annual depreciation is of rupees 90,000. And you are talking about the depreciation over the period of time. By the time we are hitting the portion of 10th year, it is actually 9,000. Yeah. The depreciation is of rupees 9,000. You know, if the depreciation is of rupees 9,000, so by the end of the 10th year, the depreciation till now would be 9,000 multiplied by 10. That means 90,000 is the depreciation that has been charged till the end of 10th years. So out of 2 lakh rupees, you remove the area of 90,000, what you're left with is 1 lakh 10,000 is your amount of machinery. ठीक है ना? So in this case, the answer is 1,10,000. What I'll do is in the PDF, I'll just simplify it further. I'd given the entire portion, but I might have to edit this part. So what I'll do is I'll edit it for you in the particular PDF. You can find the PDFs in my Telegram channel and we'll be soon making it available. What you can do is you can download the app from where you can do the same. Acha everyone, one more thing. If you're looking forward towards your classes, ki acha, we want to look out for some sessions. We want to have the paid classes, right? You're preparing for this examination. Then what can you do? Now, in this case, what you need to do is go on to the era of Adda 24/7. Okay? Best is you have the app because app is way better. Now you have come to this area, that is www.adda247.com. As soon as you come to this area, what you need to do is click on the area of JIB and CIB. Clicked on it, right? So as soon as you'll click on the area of JIB and CIB, you will find only JIB. You will find only JIB plus bank promotion, preparing for both. Or you can also prepare not only for this, but or you can also prepare for the area of JAIB plus CIB. That is available in the form of Mahapacks. JAIB CIB Mahapack, JIB Mahapack, and JIB plus promotion Mahapack. Okay, all these are available. What you can do is click on this, click on the area of buy now, use the code Y541 and you will get a discount of 78% if you're using the app. So that means if you're thinking to buy it, you can buy it for validity of 12 months. That is JIB CIB Mahapack. That is available for the validity of 12 months there, and that is available for 12073. Mahapack means what? In the Mahapack, you have bilingual and English medium both classes, test series as well as the recorded classes as well as live classes, because previous batches, current batches and the future batches till the time you have the validity, all those classes are available for you under this. Along with this, ebooks are also available, and 10 plus hours of mini marathon, 5 plus hours of the Maha Marathon is available under this. Plus, the doubt classes are separately available as well. So, these are all the things which you will find in our JIB CIB Mahapack 2.0. So, if you're looking forward to it, then hurry up, right? Go ahead and start your preparation now. I'll be meeting you in the next class at the same time. Thank you.